All right. Thanks for that, Pankaj. Let me also welcome in Sailesh Bhan. Now he's also joining us. We've been focusing a lot on the pharma segment, the kind of emerging leadership we potentially see there. Sailesh, thanks for joining us. Just want to get your perspective on this, the rebound that we're seeing in pharma. Do you see this as a slightly more broad-based, opportunity here? Are you focusing more on the leaders in the pack? What's your assessment of the situation?
Yeah. Hi, good morning. See, this sector has been starting to show improvement now for nearly 12 to 18 months from where its earnings have, from bottomed out about, say, 1.5 years back. So from there on, we have seen a material improvement in earnings coming across the board. Primarily, the initial move was all domestic-based pharma businesses, and now it's spreading to even businesses which have significant global exposure. This trend, we believe, is a sustainable trend because it is coming off a 4-5 year difficult environment for the sector. And second, valuations and even expectations for the sector are way below what the sector can actually deliver. And I think the promise for the sector lies ahead.
Okay. So if we were to break it down a bit, you said even with companies like with global exposure, if we take a look just at some of the names that have been trading at those at higher levels, Sun Pharma, Aurobindo, Lupin, Dr. Reddy's, across the board, anything that's standing out to you in particular?
See, I would want to comment on specific categories within the sector than companies. This sector, if you look at the valuations of most companies, they were not valuing the international business. The markets were not valuing the international businesses at all. In fact, they were giving zero or negative value to the international business because of what has happened in the last 3-4 years. So I think in larger businesses and larger companies where international businesses are dominant, there was virtually no value being given, and that is now getting re-rated. Overall, if you see, most of these businesses are still at 5-year, 10-year low in terms of multiples and in terms of absolute prices also in some cases. And hence the journey is very, very long. So primarily, the domestic businesses will continue to do well because they are secular, consumer-like stories, the branded businesses, which can go at 12-15% compounding. But more interestingly will be the international opportunity because they are just not in the prices for a lot of these companies. So I think both segments of the market have tremendous opportunity. The third piece, which is, which is really, in my reading, massively impacted by what has happened on the coronavirus front, is the fact that the emphasis on healthcare. Healthcare will become the most important issue for the world to deal with in the next few years. And when you look at India's spend on healthcare, primarily it's all private sector, and whatever the government spend is a very small portion of what is really needed for the country of the scale. And I think there will be a disproportionate jump in what money will get allocated to this sector, both from public as well as private investments in the next 1 to 3 years or even more. This will create tremendous opportunity for all healthcare services. The general awareness levels itself move up, so a disproportionate level of testing and associated activities and services will happen. And this, I think, will be a long secular trend for the sector itself.
Sure, and we can see that really play out. The way some of these pharma stocks have jumped up is quite remarkable. But Sailesh, overall, I mean, what is it that you're witnessing about investor sentiment right now? And do you sense that what's transpired as a result of the COVID-19 pandemic, do you see retail actually getting out of equities? What we saw in 2008, could it be replicated right now? And then it takes them a long time to really come back to equities because they've burnt their fingers that badly? Or do you not sense that that's going to play out this time around?
Yeah. See, there is a big difference in what happened in 2008. In 2008, you didn't have so much of SIPs working. In India today, more than 2 crore SIPs are underway, which systematically are kind of contributing to the flow into the market. And most of these investors, I think roughly 30% of all the money which has come into mutual funds have come via an SIP route. A lot of these investors are coming with some time frame in mind, and more importantly with, say, a goal attached to some of their SIPs which are there. So I think, rationally speaking, the retail participation and endurance of this fall, I think they are far more resilient than before. In fact, you could see there has been a lot of international institutions selling over the last few months and you've seen retail actually continuing to hit the SIP book and contribute to investing in equities. So I think this endurance and the sustainability seems to be way, way better and bigger than what it was in 2008. And I think if markets rebound quickly, you'll find this kind of continuation likely to be there.
Sure. But what is it that you're sensing, Sailesh? Has the time come for one to go back to the drawing board and maybe allocate a little differently? Out of that 100 pie, how much do you allocate to large caps, to multi-caps? Do you increase allocation to small caps? Or should you be largely concentrated towards large caps right now? Because in the market recovery, I'm guessing it's the quality names which are going to spring back up first. And how much of fixed income exposure should you have in this kind of a market?
The segmental allocation, whether large caps, mid caps, and small caps, is purely a function of where valuations generally stand for each of these categories. If you look at from 2017 onwards, there was a collapse of mid and small cap companies for nearly 2.5 years. And on top of that, they have had one more setback in this recent fall. Right? So the valuations there are actually in a lot of cases closer to bankruptcy, or as if companies will not live beyond 3 years or 4 years. There are so many companies. Actually, it's also there even in mid cap and small cap spaces as well as large cap spaces. There are so many businesses at sub 5, sub 7 multiples. A lot of businesses have market caps and cash with them at 30 to 40% of their market caps. And these are businesses which will endure. So these are not something which are deep cyclical or non-enduring businesses. So I think, interestingly, value is lying in every pocket of the market today. Within this, how one should go about allocating is very simple. See, broader market is nearly 75% into large cap by market capitalization, the overall market, if you see all stocks. Depending on the risk profile of the investor, he can say 50% large cap, 50% mid and small, and the balance 50% mid and small, or he can be 75% large and 25% mid and small, depending on his risk profile. So there will be phases where different segments of the market might perform differently, but at the moment, most pockets of the market are disproportionately attractively valued. So there is actually segment by segment, there is value available in the market today.
Okay. All right, we'll leave it there. Thank you so much for joining us, Sailesh, and talking us through the latest trends as you see them. Okay, that's where we're going to leave it for today. And as we do, of course, remember, we're continuing to focus on all the preventive measures that you can take, to stay well, including, of course, keeping those masks on and making sure that you're protected, as well as, keeping the environment safe as well. So we leave you with that today. Thanks so much for watching.